This is the Millennials in Multifamily podcast, brought to you by Kronos Investment Partners. We interview industry experts to unlock key information that will help young professionals break into the multifamily world in order to create long-term and short-term wealth. If you enjoyed the show, please head over to iTunes and leave a rating and written review so we can reach more listeners.
Hello, and thank you for joining us on another episode of the Millennials in Multifamily podcast. I'm your host, John Stober, with my co-host, Fritz Ritter, and today our guest is Hemal Badiani. Hemal is a banking executive, and over the last 2 decades has provided management consulting services to several Fortune 100 companies, while simultaneously also creating a portfolio of businesses. One of those businesses is Exponential Equity, his real estate investment company that focuses on high-velocity investments and ensuring faster returns along with long-term wealth potential.
Hemal Badiani, thank you so much for coming on today's episode of the Millennials and Multifamily podcast. Could you tell us and your listeners just a little bit about your background, what you did before multifamily, and then how you ended up transitioning into the space?
Yeah, absolutely. First of all, John, Fritz, absolutely honored and humbled to be here on this podcast. You guys are rocking it, both from a education standpoint and actually executing on the deals and with the social media stuff. So thrilled to be here, and thank you for welcoming me to this podcast. For my journey, just a little bit short bio on that. Basically, I started in the management consulting space for about 15 years. I was traveling in 3 continents, lived the life in a suitcase, worked with Fortune 100 firms, everyone from Disney theme parks to the Vatican, and really, really enjoyed the time that was. But it was all about helping other big companies and CEOs with their problems, right? And it could be very unique problems or very big problems that they had. So I really developed that problem-solving mentality, the patience, the focus, the positive mindset that's required, and quickly jumped into the banking industry over the last couple of years as one of the banks was struggling, trying to help them steer in the right direction. And in the meantime, got some time on my hand, jumping from not a traveling job to sitting and working at home for the most part type of job, and really developed that passion that I had for real estate. It was building a conventional portfolio over the last decade, and went into wholesaling and flipping in 2019, and was super successful, scaled very fast, had 5 VAs at one time, virtual assistants, for those who don't know VAs, and really did a whole bunch of stuff in the wholesaling flipping side, but was transactional, was becoming a second job. And talking to distressed owners was really not my thing. So decided to do what I could do best, which is helping people as a team and building up and filling in the gap and solving their problems, where commercial multifamily comes into play. So started multifamily, educating myself December 2019 through February 2020, and did our first deal in April of 2020, and we're rocking and rolling since then.
Wow, that's a really quick turnaround time from December 2019 to April 2020. So with your management consulting background and your ability to solve problems, and as you said, think positively and optimistically, how were you able to insert yourself into that first deal so quickly?
Yeah, it was some of it was luck, some of it was alignment of stars, and some of it was just me seeking out the right partners to partner up with. So I quickly realized that one way to do things, which a lot of people do, is buy a duplex and then a quadruplex and then slowly scale their way up, learning all aspects of multifamily, which is fantastic, and everybody should know that, and understand the asset management side, understand the capital side, understand the marketing side, etc. But given where I was, I had a certain set of skills that I was bringing to the table. And what I did was intentionally try and partner up with 3 or 4 teams that had a complementary set of skills. So they came from the construction industry, They really had the experience on the residential side or other commercial assets, but really truly needed that help for someone to be the CIO and help with the marketing, investor relationships, capital raising, systems and processes for automation, etc. And that's where I offered up my value and really wanted to go 100 units plus off the bat. And having those 3 or 4 teams or partners now allows me to hopefully close one deal every 30 to 60 days, because each partner would be targeting 2 to 3 deals a year, and having 4 partners just allows me to have that scale and build up faster while providing the value within my lane and what my expertise and strength is, which I've developed over the last couple of decades.
So I think a lot of people, they have trouble finding one partner. You found 4. Do you have any advice or strategies to impart on the listeners who, may be looking for that strategic partnership?
Yeah, absolutely. So one advice would be find the type of deal, right? Beginning with an end in mind, find the type of deal that you want to do, right? And when I say that is, do you want to play in the 20 to 50 units, 50 to 100 units, 100 to 200 or 200 plus? Do you want to think about a conventional model, or there's so many creative ways that syndications are done right now with two-tiered structures, different types of fees? The model that we perform, which is very unique, exit strategies, whether people are holding it for 5 years, 20 years. Really write down what your goals and values align to, and really define that scope of type of syndication structure that you want to partner with. That's part one. Second, there's always going to be mentors and guides. I feel like mentorship, both from a performance and alignment standpoint and raising the game standpoint, and also core competency in the multifamily world, is really important. I have 2 coaches all the time. And finding that coach who subscribes to that syndication model. And the third thing is then going to those meetups. Now it's really challenging, and I had the good fortune to really build some of these relationships in person pre-COVID during that January to March timeframe. But really talk to people, right? Understand without trying to just make a deal, really talk to them, understand where they come from, where they want to be, right? Do they want to scale to 500 units in 5 years or 1 year? What is their dream? What is their goal? They want to retire. They're looking for freedom. They want to build a business. So again, alignment of principles, and it's going to be a long-term partnership, and partnerships are like marriages, right? So you want to make sure that you're talking to those right peoples. And whether it's 1 partner or 4 partners, at the end of the day, a good partner could make 1 + 1 = 3, and a bad partner could take you down. So it's really important to find those and subscribe to that similarity of thinking and values, to be honest.
So would you say that the coaching accelerated the learning curve to find those strategic partnerships, or are there just some strategies that you're doing differently from everyone else to attract people to you?
No, so the coaching, definitely being in that coaching team allowed me to go to an event where I've met 2 out of my 4 partners, and then through their referrals met the other 2 partners. So really, I would say that path of subscribing to that coaching and mentorship program really led to that partnership model. But had I not spent the time to go during those 3-day events that these coaching models have, to really pick out those 2 or 3 people and say, hey, forget what's been taught here, because we all know some of it now by the basics, right? And it's online. Let's really go and grab some beers or grab a lunch. Let's talk for a couple of hours. Then spoke to them over the phone for multiple times to really understand the values and cultivated that relationship, right? Partnership has to be very careful in my mind. You cannot jump the gun there. And it really has to be done over a period of time that you kind of understand before you understand where you're going to play. The third thing was then it was just about, hey, I don't want to be the asset management guy. I don't understand construction. And while I can learn that competency like anything else over the next 5 years, if you already have that since the last 2 decades, that's perfect, right? And you don't understand certain things or you don't want to do certain things. It doesn't drive you, doesn't wake you up in the morning to do that. Things like these, having conversations, educating people, paying it forward. This is what drives me. I could do this whole day, right? So that's what I want to do. And the operating partners want to do, which is managing the actual asset.
So I'm curious, with your management consulting background and your ability to solve problems, what are the most common problems you see in the space that you think that background has given you a competitive advantage in order to solve?
Yeah. The biggest problem that I see is either you are a very established, seasoned investor in a company, right? That is usually plastered all over the internet, talking about deals, and educating and doing a lot of things. So there's a handful of people that are doing that. The people who are trying to come up new, the biggest challenge they have, especially on the operations side, is they don't know how to put together the marketing materials to have conversations with sophisticated investors. And I don't mean sophisticated as non-accredited, I mean sophisticated as seasoned investors like private equity firms, because they don't believe they have the track record to have those types of conversations and build those relationships to take them to the next level very fast. And that's where because of my management consulting background and a lot of relationships that I have with those private equity firms, can really bridge that gap, right? And really understand what the private equity firms are looking for in terms of, even if it's your first investment, what are they looking for when they look at your track record and how you've analyzed or stress tested the deal versus what a really passive one-time investor who might be moving from a single family to multifamily investor might be looking at. So that's what I've been able to really successfully do is, like I said, be that CIO, Chief Investment Officer, and Investor Relations Officer, so CIRO, and really help them understand how to do this better and how to do it at a point where it really not looks like, but really feels like a firm that knows what they're doing, not just building the asset and managing it, but really want to scale it into as a business.
So how would you attract them? How would you recommend that other people attract these private equity firms?
Yeah, so you research on them, and it's relationships, right? So it's either through meetups. Sometimes it's frankly phone calls, right? I've had conversations where I was speaking with someone else who was doing private equity deals, and I said, hey, this is what's coming up. Would you like to add value and help me out here? And that led to a conversation where we talked to a very equity-only partnership. LinkedIn has been fantastic. We met with a company of hedge fund of family offices, essentially in Europe, that we started speaking with. They're like 5 billionaires have come together and put together a family office. And their thing is, if we like you, they can open up a couple of $100 million in line of credit for you to start buying assets, right? So these are, sometimes I even like, okay, where am I going here with these calls, right? But essentially trying to understand it, and we put it forward, right? This is where we are on our journey. This is our background. We've all been successful in different aspects. This team is coming together, in its first set of deals. We don't own several thousand assets as of now collectively, as a group, but individually we all come from very successful backgrounds, and this potent combination of this team could really be a valued partner to them, and that's why they should trust us. So then it becomes a conversation, and again, some people would like that partnership, some might not, some might ask for a different share that might not be appealing to you. But again, if you knock the door enough times, you're bound to make some inroads, right? And I think people really get scared of family offices and private equity as they're starting, because it's easier to talk to friends and family. It's easier to have conversations and say, hey, in smaller deals to invest $50, $100, $200,000. But when you want to hit 800,000 unit deals and you want to raise multiple $1 million, you start coming up short in your dreams.
So if you're going to pitch to like a private equity firm or multiple billionaires,
Yeah.
is there anything you would do differently in your pitch than if you were talking to friends and family?
Yes. But a lot of our operating investor memorandum looks different, right? They look at metrics such as XIRR and MIRR. They look at preferred equity type of percentage. They look at a different level of valuation. Like when we went to one of these family offices, they actually found data that we even had found on the deal itself, right? There was like 20 years back, there was some sort of big felony in that building, and we didn't know that. So they really test you out, and the level of sophistication that is required for an investor memorandum, the modeling of the financial modeling that is done, and actually stress testing the deal and answering their questions is quite different than just presenting an investor summary or having a conversation with a sophisticated or accredited investor.
Could you dive a little? Sorry.
I was going to say, we probably have the same question. I was going to say, could you dive into what XIR, MIR, and the equity percentage means?
Yeah, so John's probably going to know more about this, but when we think about IRR ratios, right, we look at typically on a yearly forecasted models, right? So even if you're returning money in 18 months instead of 2 years, in an IRR calculation, you typically look at 2 years as a basis, right? In an XIRR conversation, you're looking down to the monthly level. So it provides you a different ratio on when is your money specifically coming back. And then they typically look for preferred equity. So most of the conventional models, if you think about the capital stack portfolio, you've got your senior debt, you got your mezzanine debt, your supplemental debt. And then you typically have common equity or between your general partners and your limited partners. The family offices, for the most part, want to get paid first, right? Because they're assuming the biggest level of risk. And the third thing to take care of is even though they might be interested, they might sometimes come with just 95%. So on larger deals, 5% of the overall raise could still come out of your pocket or from common equity. So it's not an end-all be-all solution. But once they get engaged with you and they like your team and they want to do work again and again with you, then it becomes just like any other partnership, and you start looking at one-stop shop rather than shopping a deal around or doing webinars. You just talking to a single entity and you're getting a yay or nay on a specific investment. So I believe it becomes easier once you do that.
Yeah, no, that sounds a lot easier. If you get one big investor.
Yes.
So you've said that they want to get paid first. Does that mean they're in a tranche above that common equity pool? Or, I mean, are they supplying? So they're providing like preferred equity.
Preferred equity. Yeah.
Mm-hmm. And then could you talk about like what do they do differently when they're stress testing the deal, and just how are they modeling it differently besides looking at like XIRR and monthly cash flows and distributions?
Yeah. So some of their models are pretty opaque for investors like us, right? So one of the partners that we're working with right now, just to test out a deal, right? We're not going to go with them. We're looking at passive investors and we're talking to our friends and family. It's a 506B opportunity. Well, most of our deals are 506B opportunities. But for that one, they have a 25-point system to even talk to family offices before they do that. They want to run the deal through that 25-point system, and that means analysis of our track records, our financial statements, our tax returns, and our overall portfolio, plus the analysis of the deal itself in their own models. So we right now, this week, we're going to send them the investor memorandum and our financial analysis and see how we score in that 25 points, because to that end, they can talk to some of the family offices and understand who would be interested.
And then, so with them providing preferred equity and you said lines of credit, how has that enabled you to finance your deals differently or more creatively than other people who would just have first position debt from a lender and then they just go out and raise equity for the rest?
Yeah. So for us, our deals so far have not been through them. We're still engaging with them. Our deals have been very unique. One thing we're doing with each of our deals is looking at the creative side. So we always ask for the seller to see if they have a seller financing option. And that could be 20% of the overall deal, or could be 100% of the overall deal if it's free and clear. And at that stage, it becomes easier to have a conversation on whether, if they can seller finance 100% of the deal at 4.5%, 5%, then it's a easy math to see if your debt service ratio currently and that debt services at 5% match the current net operating income. And if it comes out super positive, then you're in a good deal and you're not haggling too much trying to get them down significantly on the price side, because our model is to really buy distressed assets at a very low price. Usually we buy on an average 29,000 to 49,000 a door, all in price, right? So including renovation. So we buy way cheaper than most of the syndication models out there. And the reason we do that is we go direct to sellers. We do a lot of marketing direct to sellers. We talk to sellers directly on the phones, mailers, and really help build the relationships. And before it hits the market with a broker and multiple people are bidding on it, we try to buy these deals. And the COVID environment has made a lot of sellers open to having those seller financing options. And that just makes it easier. You're not going to a loan sponsor. Most of these assets are distressed, so you're not going to get a long-term Fannie Mae or Freddie Mac loan. You would have to go to a bridge loan lender. The environment right now is challenging, as one can imagine, with bridge loans. So it's easier to procure the asset, easier to solve the problem for a seller. And it's a question of asking questions, right? And what are you going to do with your money, right? Oh, I don't know yet. Well, would you like to get it paid in a lump sum, or would you like to get some monthly installment for your retirement? And many a times, that just changes the conversation to be open to seller financing. That's what we've been successful at.
So something a challenge that we've run into is, so we bought a property with a lease option, or I guess technically a master lease, which is creative financing. But with a bridge loan, you get CapEx funded into your rehab. So how are you funding that when you're doing these seller financing options?
Yeah, that CapEx is a raise, right? And our model, again, is preferred equity for investors as well. So a few things just to highlight what we do is different. In addition to that direct-to-seller type of investment opportunity we buy, what we found out is a lot of people want to build wealth with real estate, but they're tired of waiting 5, 7, 10 years to get their capital back, right? And given the volatility of the market, if the Tesla stock comes down to 90, I want to put in some money there, right? At play, right? So there's so many sometimes opportunities that most investors are hesitant to be completely not liquid by putting in a long-term syndication deals. So what we've created is a model where passive investor's money is only in play for 18 months to 2 years rather than 5 to 7 years. And in that time period, we don't charge any fees. Most of the times, we don't even charge acquisitions fee. We don't charge asset management fee all the time. We don't charge any disposition fee. So we basically work for free for 18 months. And our incentive is to stabilize the asset for 18 months. So let's say we bought this property, a humongous property in the South right now, close to 400 units that we have under contract. It's overall 68% occupied, and we're looking to in 18 months, get it to 90+% occupied. And at that stage, when we go to refinance a stabilized asset, we are able to pay the investors back their capital, the original loan, plus 10% fixed preferred for that 18 months, so 15% in total, plus a percentage of the refi proceeds, which are tax-free. So they typically, our investors walk away with 12 to 15% cash-on-cash returns on any deal. And they get their money back in 18 months. Plus, at the end of that 18 months, they get an equity percentage in the deal, which is going to generate them infinite returns. So when we have such a model, no investor that we talk to ever wants to invest now in 6-year deals, 7 years deals, right? They want to stick to, because by the time they get one standard syndication deal complete at 15 IRR, we are honestly providing them a 30% plus IRR in the first 18 months while their capital is play. And every 18 months, they can be building a new asset or divesting their money into stocks or other things that might be going on. So that's the way we've been able to oversubscribe, even with just friends and family. We have not had an opportunity to do any 506C deals. We're just sticking to 506B and word of mouth, building those relationships, and really being the equity raise has been the easiest part, to be honest.
Are you struggling to understand how to underwrite multifamily properties? Hi, I'm John Stober, and I completely understand your problem. I thought underwriting would come naturally to me due to my background in finance and accounting, but I quickly found out that there aren't a lot of resources that cover this subject. I had no idea whether what I was doing was right, wrong, or just original. I don't want you to have to pick up little nuggets here and there like I did. So I wrote an ebook called How to Analyze Big Apartment Buildings and Make Them Feel Small that puts together all the pieces of the puzzle. We're also giving away a deal analyzer with the ebook, and they're both completely free. Don't wait as long as I did to start chasing financial freedom. Go to bit.ly/underwriting ebook and get your free copy today.
So does that mean that you can't buy deals? Let's say if you were going to add enough value where you could refi and give them half of their capital back, like it has to be all of the capital back at refi. Mm-hmm.
That's the only way the general partners get a dime out of the whole thing is they need to refinance at a point where all the investors' capital plus 10% fixed preferred plus refi proceeds are given to the investors first, and then we get some money.
So how many deals does that eliminate that would otherwise have be good in like a traditional syndication model?
Yeah, I would say 95% or more, maybe. Yeah, and that's why you wouldn't see us in the top 10 MSAs, right? We are not interested in overbidding in this economy where things can go south, your physical vacancies can go up. We are very risk-free, risk-averse, right? We want to buy an asset at a discount, which is at current net operating income 1.8 or more of debt service ratio at current income, and has a low occupancy. We don't assume at all that we would raise rent for the next 3 to 4 years. And we only assume that we would be putting the best product in the market with granite countertops, hardened asset that is $75, $100, $150 less than the competition. And that's what we stress test and conservatively write at. And the reason we can do that is going back to our purchase price, right? We buy it at $29,000 to $49,000 a door. And you can't beat that when you're buying something at $80,000, $100,000 a door in a bigger city. At that stage, you're looking at, bumping up the rents every year as an assumption, and things like COVID can put a ding into that kind of assumption, right? We are not playing on that. We are looking at occupancy and bumping up the occupancy.
So I wanted to go back to the refi out of the 18-month. How do the splits work on that? What type of percentage do they get after you refi all their money back?
Yeah, it's a great question, right? Yeah, so we typically, if you think about typical syndication model, it's 60-40, 70-30, 80-20, whatever that split is. But that's where the operating partners, rightfully so, because they do a lot of work, uh, have a lot of fees that they built in, right? And a waterfall structure and a promote structure. We don't have any of that. We don't zero waterfall. It's a straight split. Our splits are smaller for the limited partners than a general syndication is. And the reason that is at that stage, it's all infinite returns, right? And the equity that they build in, plus the annual cash flow that they would get on a yearly basis, just from that infinite returns, is more than any other investment that 15 IRR or 17 IRR that any typical syndication can provide. So that's why our investors, again, it depends on the deal, right? How many units are being subscribed, how much is the raise, that allows us to understand what's the right equity that allows us to provide in the first 18 months 30+% IRR. And that's our threshold, is getting investors return, cash on cash return between 12 and 15% annualized for the first 18 months, and 30+% IRR for the first 18 months.
So Hamal, you closed on a 208 unit earlier this year, right?
Yep, June. Yeah, it's still closed on it. We almost closed on it. Still got an extension from the lender, so we are a few days away, and we've got the light at the end of the tunnel. We've got the extension signed off, and it's everything is subscribed. Investors are subscribed. Everything is all done. Just needs to tie the bow to it and call it closed and pop up the champagne.
So, so this model of yours fascinates me. I'm wondering
Yes.
if you could share what the numbers look like on this 208 unit and just like what this model actually looks like in action.
Yeah. So I'm not sure, given that it's not closed, so I cannot, as a 506B opportunity, I cannot talk about the details.
Mhm.
But let's just take a random asset, right? That we bought at $6 million and putting in, or $7 million, and we're putting in a $3 million raise. That includes closing costs and all the renovations that need to be done, because these are heavier lifts. So most of these assets would require not the usual, hey, 2015, it was renovated and right now it's 94% occupied and you're buying that asset. So let's say $7 million asset plus a $3 million in terms of renovations and closing costs. So all in was $10 million. We would typically, based on the occupancy increasing 30%, if it's a 60% occupied, or 40%, we would typically project that at 15 million, 14 million conservatively as its stabilized asset in 18 months to 24 months. And that's an achievable target, right? Just because we're increasing the occupancy and thereby increasing the net operating income, all other things being considered the same. Look at the trends on how that's been done, why property management has been able to do certain things or not being able to do certain things. Whatever the distress problem is, you're trying to solve that problem at the end of the day. And so at 18 months, at 15 million, we would go back, get a long-term Fannie Mae, Freddie Mac loan or HUD loan at that 3.7%, or whatever the numbers can come out to at that stage. And let's say we got $11 million back, right? In the meantime, that property has performed right now. It's able to service its debts, plus pay the 10% to the investors. Remember, we don't earn a dime during that time, right? So we're just paying off the investors the 10% out of the income that's being generated currently. And at 18 months, we got 11 million back. We put forward the 10 million that was taken from 7 million from the original loan and 3 million from the investors, return that capital back. Now we got $1 million of refi proceeds, which are tax-free. And that's what we split between the general partners and the passive investors at that stage. And then they can do whatever they need to with that asset, and we continue to operate it. We like to buy and hold, keep it for 10 plus years. We're not doing a depreciation only play where we try to sell the asset at 5 years. We believe that generational wealth would be created if you keep an asset long terms, 15, 20 years, pass it on to generations. And that's what we do. Obviously, there's always never say never, right? So if somebody offers a ridiculous price, you want to sell the asset. It makes more sense, prudent sense to sell it.
And so once you've refied and given them all their money back, you split those proceeds. Generally, how much of the cash flow are you splitting with those investors, or is the cash flow?
Whatever their percentage is. So let's say the passive investors are 20% or 25% of the overall deal. They get 20 or 25% of the refi proceeds. They get 25% of the annual cash flow. They get 25% of the annual net sale or overall net sale proceeds that happen whenever that sale event happens. So it's a very straight up, no cuts, no waterfalls, nothing like that. They're just true partners of ours that believed in us, that we could make this asset better performing than what it is right now. And we're going to work really, really hard because we're incentivized to make sure they get their money back before we earn something.
And if you're raising most of the money from them, is that just something that's talked about at the beginning? Hey, after the refi, it's gonna, you're gonna get 25%.
Yeah, it's part of the PPM, part of the operating agreement, part of our investor decks, part of our internal webinars that we do with friends and family. Everywhere it's plastered, right? At the end of the day, some people ask, well, hey, I'm getting 70% here in the conventional syndication. Why only 20% or 25%? And the answer is, to be honest, tell me an investment where you can get 12 to 15 cash on cash and a 30% IRR. And do you really care when you invest in Tesla what Elon Musk makes? Right? At the end of the day, our investment from a cash on cash and IRR and annualized return perspective is way superior, in my opinion, at least, because I invest in this. And I put my money where my mouth is, right? I put a lot of my capital, most of the deals we have, I'm either invested from an earnest money standpoint or I put in at least some capital into it because I believe in these deals and opportunities, and I wouldn't ask someone else to invest in it if I didn't believe in them. So I believe that they're a superior structure. You can talk about risk differently, right? A stabilized asset in a metropolitan area versus a distressed asset in a secondary city. Some people could perceive that as different risk. And again, we are not trying to speculate on the rent growth. We're trying to speculate on the occupancy. So if the metrics of the overall market are not showing us that it's going heavily negative, it's even a stable to little growing population, I think we'll do fine.
And so you said you're going direct to owner for these properties, and you've done some wholesaling and some flipping too. So I'm wondering, what's the difference between talking with an apartment owner of like 200 units versus someone with like a distressed home?
Yeah, it's completely different and similar at the same time, right? Similar in the sense that you're trying to solve a problem. You're trying to understand if there is a tire kicking going on, or is there they're just taking a mickey out of you. Is it going on, or they really want? Are you at the right time approaching someone who has a problem? And do you have multiple tools in your toolkit to resolve them through creative options or whatever their pain point is, right? If their pain point is the management is too detailed. We actually spoke last week with a 85-year-old gentleman in Alaska, right? I mean, he has a property in Alabama, 100 plus units, right? And he's bought it at seller financed. He said, hey, would you write one more note and we can buy it 100% seller finance? Because his issue is somebody's managing it, but he doesn't know what the heck they're doing. And he cannot, at 85 years old, go from Alaska to Alabama to manage this property. So it all comes down to what problem or issue they have. And if they don't have any, if timing is not an issue, if the property is not really truly distressed in some way, right? They're better off going through a broker. They're better off getting a lot of bids out there, and they can get the best price if they can wait, or if the deal is like completely smooth, right? A lot of new investors and a lot of conventional joint venture partnerships or syndications are looking for those models. So that's what we advise, right? You want to be a trusted advisor to the people you're talking to, and also want to make sure that they are successful and happy at the end of the transaction. And that's where you feel fulfilled. So that's the similarity part. The complexity or the difference is the level of sophistication, right? A 50 to 100 unit can be a mom and pop type of investor, but once you go 200 plus, and some of our deals are now 300, 400 units, you're dealing with a different level of individual, right? They might be under a trust, they might have multiple partners that might be holding the deal, they might have different reasons for letting go of the asset. But at the end of the day, they have to have some problem, and you should know how to respond and truly help them out of the situation that they are in, right? And it really takes a lot of questioning, understanding, listening, patience, and building the rapport, rather than a transactional conversation with a broker that you might have. Hey, is this deal look good or not? Is this a value add or not? And here's my bid type of deal. So it's a different ballgame, to be honest.
Yeah, Hemal, I wanted to ask you how the mailers differentiate, because in single family, you might just say, hey, we buy houses.
Yeah.
So, I mean, I can't imagine you say, hey, we buy apartment buildings. So what are you
Yeah.
putting on? What's the message you're trying to convey on these mailers to these apartment owners?
Yeah, mailers we've stopped. It wasn't
Okay.
that effective. We do a little bit of texting, but we also, it's more phone calls. And then now because we now have relations with some of these family offices, some of them have just off-market deals coming to them, larger portfolios that you would never see in the market at all, right? And even if you ask a local broker, they'll be like, yeah, I don't think that building's for sale, but it comes to us, right? So it's just been different steps, right? You cannot have one single track. You kind of do A/B testing on with software allows you to have such leads, which brokers, sometimes you go to wholesalers, you got to be in their list. They are sending deals all the time. Yeah, you really have to understand how to pre-qualify them in 5 minutes, 10 minutes or less, to really, because you have to say no to 95% of the deals. And out of the 5% you say, maybe you underwrite 200 deals, you might get one or two that truly works in this model beyond that 5-10 minutes that you said yes to, right? So it really a lot of hard work to get some of these unicorns. And that's why it takes 3 or 4 partnership teams to get a deal flow pipeline going that is as strong as ours.
So after you've spoken with a seller, and if they're open to seller financing or creative financing,
Mm-hmm.
what types of lenders are you using to stack the debt if the seller can't finance the entire purchase?
Yeah, so it's bridge lenders and mortgage brokers, right? So folks like Eastern Union, Peak Financing, Madison Investments. We go a lot to some of the lenders directly now. We have a couple of great relations with mortgage brokers who can help us out with some of these things as well. And we just build the loan package and the financial package, putting in the CoStar reports, putting in what we're trying to do from a business plan perspective, very verbose stuff rather than the investor summary. And, they help us shop it around. Yeah. And sometimes these are recourse loans. Sometimes, most of the times, they're non-recourse bridge loans. They are at a higher percentage than what you can find at Fannie Mae, Freddie Mac right now. But that's again, you understanding that you're buying something at 1.8 to 2 times the DSCR ratio. allows you to have that enough bandwidth and moat to not only service your debts, but also pay most, if not all, of the 10% return to your investors without taking any sort of cut from your side because you're not charging any fees.
So you're getting a bridge loan, and
Yep.
you're getting the seller to carry a portion as well sometimes.
Yep. Yeah, sometimes the seller would agree to a personal promissory note that allows us to, that's a personal collateral between the partners and the seller. And what that does is it's not a lien against property, right? The property only has a bridge loan, but we make a transaction with the seller to say, hey, or what we do is we do a partnership with them to say, hey, we will buy the asset at the loan plus $500,000, and you have a preferred equity in the transaction for 10 to 20% or whatever that comes out to. There's so many ways creatively that you could think about how to procure an asset. Again, it depends on what the seller wants, right? If they just want out of it, it's an all cash transaction. You're better off with a bridge loan or assuming their loan plus raising all the money. But if they're open to more creative options, then you need to understand what things you can do, what you cannot. Certain constraints come with loan assumptions versus new debt, for example. What banks, local banks versus national banks would accept from a financing perspective, where you're bringing that 25-30% raise from is also something that they are stringent on or not stringent on. So it really requires a lot of putting the puzzle together to sometimes come up with that creative option.
What would it look like for the seller if they took a 10 to 20% preferred equity stake?
Yeah, so you could do it both ways. One, just treat them like a limited partner, right? So at 20% equity stake in 18 months, they get their capital 20% back, and you just take a smaller percentage of the refi proceeds. Or they could be just a 20% partner in the syndication throughout the life of the asset. And again, depends on what number they have in mind, which is what their sales price looks like. And it's either my price and their terms or their price and my terms, right? So if they, for this $10 million deal that we talked about, if they say, hey, $12 million for this deal, but can I pay them that $2 million over a lifetime of 5 years or 7 years? If I could do that, suddenly, and I can service my debt pretty easily and satisfy my investor returns plus earn money for myself. Now I have created a win-win situation where they're walking away happy, but also getting us the asset that we believe in, that we can turn it around and make it into a better community for the people to live in.
And so if they're taking a preferred or limited partner stake, that's just, that's less cash you have to bring to the deal.
Exactly.
Wow.
Yep. Yeah. Significantly reduces the cash you have to bring to the deal.
Well, Hemal, unfortunately, we are over time.
Oh, wow.
So I wanted to get to our last section of the show called the Fast Five.
Yeah, let's do it.
Yeah. All right. And we may have to have you back on.
I think we
Absolutely,
will.
Man. Happy to talk, man.
All right. So question number one, if you had to start all over again and you were in your early 20s, how would you do that?
I would hire a performance coach first, who would raise my mindset to believe that I can make $1 billion if I need to in 18 months. And then choose a path which truly makes me happy on a daily basis, because I don't want to do jobs.
I like that.
I don't want to do jobs either.
Yeah, jobs aren't that fun.
No.
Question number two, how do you see young professionals adding the most value to experienced operators in this space?
Yeah, it's bringing, to me, again, the gap is experienced operators. Many of them have not figured out the social media, the marketing, the automation, the systems and processes. So if that's something that you're able to provide and do, that's definitely something that as a partner or as a company executive, that's something that I think is highly desirable as a skill set to have within the syndication team.
Yep, definitely the social media part.
Yeah.
Question number 3. What's the biggest mistake you've made in your career, and how have you since adjusted your business?
Yeah, mistake I made was, well, it's not a mistake. I think it's a learning opportunity because put me in a whole different path. Is I could have started with commercial before. I really was looking at hotels, which are not great investments right now, or are if you're looking at this truly distressed assets. But I started on the wholesaling realm, and while wholesaling gave me the opportunity to sharpen my sales skills, understand the flipping model, really cold call people, understand the distress and solve their problems. It wasn't really a business that I enjoyed thoroughly. And if I could have one more year in my life that I could have done multifamily or a few more years, then definitely would have been at a different stage. But with that said, it gave me the confidence to put some of those principles around finding direct to seller deals into action in the commercial space, and really laid that foundation which we're building on. So blessed with that experience for sure.
It's always a learning experience.
Yes, absolutely.
Question number 4, what's been your favorite way to incorporate technology and social media into your business?
Social media, we haven't done much. I don't even have a website with and I'll be at 1,500 units by the end of the year.
You need a millennial.
Yes, I need a millennial. But now we are investing very heavily in systematizing right now a website, active campaign, automation, a blogging system, and newsletters and some of those things. So in the past, and having that whole CRM investment with database, etc., and amping up the social media aspects. In the past, I mean, I'm a big lover of technology. I grew up in the technology world, right? So anything that helps me delegate and systematize things, whether it's things like Rocketbook that allows me to write paper and digitize them, or things just like Podio, etc., that I've used in the past, or task management software that I've used in the past, calendar management systems that I've used in the past. I'm a big delegator, right? So I really want to focus on the things I like from an energy perspective, and the rest of the stuff, whatever allows me to systematize that and delegate that, that's the technology I love.
And last question is, what book has been most influential to you along your journey?
Yeah, it's very cliche, but Think and Grow Rich, man. This is my second time reading it, and I was like a kid on the bed, scribbling away notes, and I'm like, this quote is awesome, then this I need to go back to. So when I read it the third time, I think I'll be able to finish it faster because I know what sections I want to read. And then I think Jim Rohn, who was the mentor to Tony Robbins, and he's unfortunately passed away now. Listening to some of those things randomly in terms of success and mindset, even before I had a performance coach, really helped. And his position on whatever you seek, you'll find, and whatever you focus on, you'll get, right? Everything else, if it becomes secondary and you focus on one thing, it's just going to come your way. And whatever time it takes, it takes. So that's been really influential.
Do you read like the translated version of Think and Grow Rich, or the original manuscript?
The original unabridged version that had a lot of things from the 60s and the 80s that are on the skipping sections the next time around. But I really wanted to resonate with Napoleon Hill's thoughts and words at that time.
Right.
And if you think about texts that go even 5,000 years back, mastering the process. Don't worry about the outcome, power of affirmations, your thoughts. All of those throughout society have been provided to us in very many forms. But I think Napoleon Hill truly brought it to a point where, a 40-year-old dude can understand it without too much thought into it and be like, yeah, why is everything else not this way? This has to be the only way to live.
Right.
Yeah, I have Jim Rohn's like collective speeches on Audible that I listen to all the time while I'm at the gym. Yeah, it's great.
Yeah. Jim Rohn is awesome.
Well, Hemal, thank you so much for coming on today's episode. If anyone wants to get in touch with you, reach out, learn more about your model or investing with you, what would be the best way for them to get in touch?
Yeah, absolutely. Connect with me on Facebook, Hemal Badiani, and then my email address is hemal@exponential-equity.com. I'm sure you provided in the show notes. I'm truly accessible and look forward to paying it forward in terms of what I've learned. And if anyone wants to be enabled with their path of success and whatever the questions they might have, definitely happy to help out. So please feel free to reach out.
Well, thank you so much for your time. This was truly a great episode.
Thank you for listening to the Millennials in Multifamily podcast, brought to you by Kronos Investment Partners. If you enjoyed the show, please leave us a rating and a written review at iTunes so that we can connect with more people. Finally, head on over to kronosinvestmentpartners.com and sign up for our newsletter so you can stay updated on everything we're doing. If you're interested in partnering with us as we find new opportunities, you can also schedule a phone call with us under the Contact Us tab at kronosinvestmentpartners.com.